Convertible bonds are a type of investment that have features of both bonds and shares. They give regular income like a bond, but they can also be converted into company shares later. This means investors get the safety of a bond along with the chance to benefit if the company performs well. About convertible bonds. A convertible bond is a type of investment that works like a mix of a bond and a share. It pays regular interest like a normal bond, but it also gives the investor an option to convert it into a fixed number of company shares after a certain period. This means an investor can first earn steady income and later choose to become a shareholder if the company performs well. The rules for conversion, such as when and how many shares can be received, are decided at the time of issuing the bond. Convertible bonds are usually safer than shares because they provide fixed returns, but they also offer the chance to benefit from rising stock prices. However, the interest rate on these bonds is generally lower than regular corporate bonds because of this added benefit of conversion. Types of convertible bonds. Convertible bonds come in different forms, but all of them combine features of both bonds and shares. Here are the main types explained in simple terms. Regular convertible bonds, these are the most common type. They pay interest at regular intervals and have a fixed maturity date. At the end of the period, investors can choose either to convert the bond into company shares at a fixed price or get back their original investment amount. This gives flexibility to the investor depending on market conditions. Mandatory convertible bonds, in this type, conversion into shares is compulsory. Investors do not have the option to get their money back in cash at maturity. These bonds still pay interest, and usually the interest rate is slightly higher because of the compulsory conversion. They are more like a mix leaning towards equity. Reverse convertible bonds, these are a bit different. Here, the company, issuer, usually has the right to decide whether the bond will be converted into shares. This decision depends on the company's share price at maturity. If the share price is favorable, the issuer may convert the bond into shares instead of paying cash. These bonds may offer higher interest rates but can involve higher risk for investors. Advantages of convertible bonds. Regular income through interest. Convertible bonds provide fixed interest payments at regular intervals, just like normal bonds. In many cases, this interest is higher than the dividends paid by shares, making them a good option for investors who want steady and predictable income. Benefit from rising share prices. These bonds give investors the option to convert them into company shares. If the company's stock price increases, investors can convert their bonds into shares and benefit from the rise in value. This gives them a chance to earn more compared to a regular bond. Lower risk compared to stocks. Convertible bonds are considered safer than direct investment in shares because they still have bond value. Even if the stock price falls, the investor continues to receive interest, and the bond retains some value. This helps reduce the overall risk. One of the advantages of convertible bonds is that the option to convert to equity affords the bondholder a degree of indexation to rising consumer prices. Convertible bonds disadvantages. Lower interest. Yield convertible bonds usually offer lower interest compared to regular bonds of the same quality. This is because they come with an extra benefit, the option to convert into shares, so investors accept lower returns in exchange for that flexibility. Conversion premium. Investors often pay a higher price for convertible bonds because of the conversion option. This extra cost is called a conversion premium. It reduces the overall return from the bond, making it slightly less attractive in terms of income. Dilution of shares. When investors convert their bonds into company shares, the total number of shares in the market increases. This can reduce the value of existing shares and affect current shareholders, as their ownership gets slightly diluted. How do convertible bonds work? Convertible bonds change their behavior depending on how the company's share price moves. This makes them a flexible and strategic investment. When the share price falls. If the company's stock price goes down, the bond acts more like a regular bond. In this situation, investors usually keep the bond to continue receiving fixed interest payments and get their money back at maturity. There is also something called the bond floor, which is the minimum value of the bond based on its interest and repayment amount. This ensures that even if the share price drops a lot, the bond does not lose too much value. When the share price rises, if the company's stock price starts increasing, the bond becomes more valuable. As the share price gets closer to the conversion price, the price at which the bond can be converted into shares, investors may find it more attractive to convert. Once the share price goes above the conversion price, the bond's value starts rising along with the stock. This allows investors to benefit from stock market gains while still having the safety of a bond if they choose not to convert. Conversion ratio of convertible bond. A convertible bond gives the investor the option to convert the bond into shares of the company. The conversion ratio tells us how many shares an investor will get when they choose to convert the bond. It is usually fixed in advance and can be shown as the number of shares per bond. For example, one bond may be converted into a certain number of shares based on this ratio. The conversion ratio is very important because it affects how attractive the bond is. If the ratio is low, the investor gets fewer shares, so conversion may not be very appealing. If the ratio is high, the investor gets more shares, making conversion more attractive, especially if the share price is rising. Convertible bond significance. Balance between safety and growth. Convertible bonds provide the safety of regular bonds through fixed interest, while also offering the chance to earn higher returns if the company's share price increases. Flexible investment option. They give investors a choice to either continue earning interest like a bond or convert into shares to benefit from stock market gains. This flexibility makes them attractive to different types of investors. Lower risk compared to stocks. Since they are partly bonds, they are less risky than directly investing in shares. Even if the stock price falls, investors still receive interest payments. Cost effective for companies. Companies can raise funds at lower interest rates compared to normal bonds because investors are attracted by the conversion option. Supports capital growth. When converted into shares, these bonds help companies increase their equity base, which can support business expansion and growth. Useful in changing market conditions. Convertible bonds perform well in both rising and falling markets. They provide stability during downturns and growth potential during uptrends.